All right. As everyone is joining and connecting to the audio and video of today's webinar, my name is Tara Spalding. It is my pleasure to welcome everyone to this live webinar on employee stock option fundamentals. We have two fantastic experts and guests today. McCoy Hill, he's a CPA and is a vice president at Scalar, and Chris Badger, another CPA and a partner at Now CFO. So if any questions when it comes to finances and monies and accounting, we have the right two experts on our program. Again, we'd like to thank you so much for coming to today's event. In particular, I'd love to thank our sponsor, Now CFO. Now CFO provides financial visibility to make smarter business decisions, especially for startups in the first 3 years. Please visit nowcfo.com for more information. If you're new to Boom Startup Accelerator, welcome. It's an honor and a pleasure to have you. Christina Neild and I are your guests for today, or guest hosts for today, and we will help moderate your interest or inquiries that you may have for Chris or McCoy. All you need to do is type it into the chat, and I already see some messages going on in the chat. Either Christina or myself will ask these questions to Chris and McCoy at the appropriate time. Boom Startup is an online and open accelerator, and we help startups break through barriers holding them back. We love working with do-it-yourself entrepreneurs. As you know, our programs are open and opt-in, so join the workshops that help you attain the goals and meet our mentors and leverage our resources as well. We serve companies located throughout the United States and through several different industries, and that's because we focus on business performance, financial management, and of course, funding preparation. We measure success by all of our participants really learning about how to improve your company's revenue stream and optimize business spends and go-to-market execution. For the set of companies that are starting to notice growth changes, Boom Startup can help set up your company for funding and vouch for authenticity because we have a platform that's tracking your growth and making suggestions as to what you need to do to be in fact fundable. And then for those who qualify for our Amplify Up program, we can help fund the first round up to $100,000. The 4 programs that we host are Pitch Up, Open Up, Rise Up, and Amplify Up. Pitch Up is our global pitch competition. Last time we did this, we had more than 200 companies apply to win over $15,000 in cash and services. And it was an absolute hoot of an event. So keep your ears open because we'll be doing it again at the beginning of the year. Open Up in our workshops such as this, where you attend, you get to meet the experts, you get to ask questions and get a deeper understanding about an important business aspect. Rise Ups are even more intense than this. They go over a 1-week period, and it's called a sprint, in fact. These are small group cohorts led by an expert where you yourself get to access a resource or a tool led by an expert and create a business plan or an activity so that your business can grow. We in fact have a Rise Up starting next week. It's led by a VP of marketing at a major bank. His name is John Huntinghouse, and he's going to be doing a product market fit and growth strategy. And if you attend, you're going to get a blueprint that's basically designed by him. And he's done this hundreds of times. He's very, very successful. So if you need more customers and you want to get out into the market faster, attend that Rise Up sprint. Additionally, we have Amplify Up. Amplify Up are for those companies that are fundable, and we take them through an 8-week training program and then end it on a demo day. And of course, we offer their first funding round through SPV, or a special purpose vehicle. And the special purpose vehicle is managed by Assure. And that not only allows the Boom startup community to invest into your company, but also your investment community too. Amplify Up is going to be launched in very soon here. So we recommend that if you're interested in the Amplify Up, to please give us your Q3 business activities through the quarterly business survey. And as I mentioned, it's just a fantastic small group co-op over an 8-week period. Now, the other aspect about Rise Up is that you get to work and connect with experts. We have a Scalar 409 valuation where you can get support and a conversation with McCoy, as well as now CFO service. And you meet Chris and his team, and they can offer and support you in any sort of regards. We'll have them tell more about these services and what their company are, but it's my pleasure to hand over the floor to McCoy and Chris at this time. And thank you so much for joining.
Awesome. Thank you, Tara. I will go ahead and I'll share my screen, give a little intro of myself, and then Chris can kind of tell us more about him. He's a lot more interesting than me. Let me know if you can see my screen.
Yep.
Perfect.
All good.
Perfect. So like Tara said, I'm with a group called Scalar. Some of you may or may not be familiar with Scalar, but Scalar is a local Salt Lake headquartered company. So a little bit of history about me. I went to school locally in the area, a couple different schools. I was playing football in college, kept getting hurt. My career kept getting extended, which resulted in me continuing to go to school, which just resulted in me keep studying accounting, get a master's degree, got my CPA, and kind of stumbled into the profession that way. And so I worked in public accounting. I worked on the audit side for several years at Tanner, which is a local firm here in Salt Lake. And some of you may be kind of offended by this. I hope I don't offend anybody here. I actually really like Tanner. I love the people there. My experience in public accounting was great. I think for me, it was, I never thought I'd be super passionate about the sales pitch of your audit is going to be pretty miserable, but it will be less miserable with us. So it's kind of exciting. I made the switch over to Scalar about 6 months ago. And it's been great. The group is great. I've really enjoyed kind of being a little bit more on the just working with exciting companies, working with founders, working with startups, and being kind of an asset instead of telling everybody what they're doing wrong all the time. So that's a little bit about me. I'm fairly new to Scalar. Like Tara said, I'm a vice president that's primarily responsible for business development activities in several markets in the West. Chris, if you want to kind of introduce yourself as well.
Awesome. Thanks, McCoy. Again, my name's Chris Badger. I'm a partner with Now CFO, and we provide fractional CFO services and accounting services for startups, emerging companies, and also well-established corporations. We work with a wide variety from, SaaS software startups to e-commerce, to manufacturing. We even we actually signed a law firm last week before Thanksgiving. So now we'll be providing accounting for law firms, but work with a wide variety of companies. We really love helping Boom Startup. And Tara and I were talking several months ago, and we're like, what's the one thing that keeps coming up again and again in conversations with startups? And it's valuations. How do I value my options, right? Nobody really cares about it. Well, everybody should care about accounting, but everybody's passionate about what the value is of their company, right? And obviously, we just want to see that grow over time. But we thought we would get the experts in, and that's why McCoy and Scalar's here to talk with us this morning about how do you value a company and kind of some different methodologies and things. And then I'll get to talk about the boring accounting stuff, but McCoy's going to take it from here and tell us about the wide, wonderful world of valuation services.
Awesome. Thanks, Chris. So I'll tell you a little bit about Scalar and the goal. Sorry, I'm all over the place. The goal of today, really, like Chris said, I think is from kind of a high level perspective for new business owners, founders, is what should I know about the world of valuation? What are kind of the practical things I need to know? We may not jump into a super deep dive into discount rates that are used and methodologies and option pricing matrices and all of that. But I think the goal today would be just to kind of understand the practical needs as valuation issues come up and how to deal with those practical needs. So a little bit about Scalar. Scalar was founded in 2009. So about 12-year-old firm. And ultimately, the thing that is interesting is I've been in different markets. As you go to engage different valuation firms, you'll see that groups look different. There's groups that are one or two people that kind of do stuff on the side. There's your big, huge national groups like your Duff and Phelps. But there's not a lot of groups. Scalar's about 60 people. There's not as many groups that are kind of pure middle market doing a lot of volume. So here's kind of some of the clients that we've worked with. Obviously up there, we've got, Slack and Zoom and Dollar Shave Club. We like to kind of flex some of the bigger clients that we've worked with, but we do work with just about every size of company, every industry, do about 200 valuations a month. And I guess the reason I think I wanted to share that is as you're going to engage someone for any type of valuation need, I just think it's important to kind of understand what they do. Are they doing a lot of volume? Are they specializing in certain types of valuations? Just to try to find a good fit for what the need that you have is. So to give you an idea, Scalar is a full service business valuation firm. What that means is we do all of these different things that are on the board, which probably kind of just looks like word vomit if you're just looking at it. But essentially, there are different reasons why we would need to do a valuation on any company. And the easiest way to think about this is we've got these four verticals. The first one is financial reporting. So this is kind of like my financial auditor told me I needed a valuation. That's kind of the reason that drives most of these financial reporting type services. The transaction advisory column is more, think of it like this is internal planning for us as a company. We want to do some type of valuation. We want to understand what we're worth, whether that be for preparing for a capital raise, any type of transaction. This is kind of an internal planning type engagement. The third one is tax services. This is the IRS is requiring me to have a valuation. And then the last one with litigation consulting is for whatever reason in the court system, there's some type of litigation going on and we need valuation for it. So kind of those triggers of my financial statement auditor, internally, the IRS and the courts are wanting me to have a valuation done. So we can kind of jump into some valuation basics, 409A basics. Like I said before, the goal here for me is just to kind of get a good understanding of 409A, so valuation in general. I'm not necessarily going to do this deep dive into stock options in terms of writing option agreements, nuances of terms, vesting, etc. I would suggest those are probably something I would consult an attorney for. And if there's questions on that at the end, I'd be more than happy to answer them, or kind of point you in the direction of somebody who may be better suited to answer, should I do a 3-year vest versus a 5-year vest? Those types of questions. So the three main things that I hope to kind of get accomplished today are, what do I need to know about valuation as I'm going into any type of valuation engagement? What are the important things for me to know? And 2 is, what is IRC 409A and how is it performed? And then the third, where I'll have Chris kind of jump in and give his input, is how do I prepare? what are the things that need to be cleaned up to be able to be prepared to come in, knock out a valuation efficiently with the documents that I need. So that first question is what do I need to know about valuation? And this is pretty intuitive, and so I apologize if this may seem redundant or intuitive, but this is something as we scope these engagements, especially people with first-time 409A type needs, this is something that I think is really important to understand. Those top three things, there's a different valuation purposes. They may have different incentives. And then valuation is as much an art as it is science. So think about if you're selling your home, right? And you look up, you kind of want to know, what is my home worth? Well, you look at the guy up the street who his home just sold for $500,000. And you look at the girl down the street and her home sold for $550,000. And so you're trying to figure out, well, what is my home worth? Both of those homes are similar size, built in similar times, kind of the same age home. It's got to probably be somewhere in that range, right? Obviously, that's kind of a simplified version, but depending on whatever valuation engagement we're doing for the business, there's always going to be some type of range, just like that real estate example. And so it's important to know that depending on what type of valuation engagement we're doing, there's certain incentives to be on different sides of that range. So for example, right, we have the home buyer that wants to be closer to that $500,000 part of the range, and we have the seller who wants to be on the $550,000. Depending on the valuation engagement we're doing, there may be incentives to be on different sides of that range, which is a little bit counterintuitive because as a business owner, right, you want your value to be as high as possible all the time. But specifically for 409A, the incentive actually is to be on the low end of the range. And we'll kind of talk about that and hit on that lower or later. But just kind of grasp as an overarching principle, there's always going to be this range that's as much art as it is science. And depending on what we're doing, there may be different incentives to be in different parts of that range. I figured probably number one questions on 409A would be costs and timing, so we can get those out of the way right away. Costs on a 409A engagement, you're typically probably going to look anywhere from $1,000 to $10,000, which is a really big range. But for a first-time 409A, we kind of joke that 409A is like the gateway drug to valuation. It's kind of the first taste that people have with getting their business valued. And for first-time 409A founders, small companies, I think it's pretty reasonable to expect to pay anywhere from $1,500 to $4,000. And all different providers will kind of structure that differently, whether it be a flat fee, whether it be a time and material. There's providers, such as Carta, who will do the cap table management, and then they'll do 409A as part of that and kind of bundle it as separate different products. But as a standalone 409A engagement, I think that $1,500, $2,000 up to $4,000 is a pretty reasonable range with what to expect to pay. And 409A is it's not a super deep dive, so these engagements shouldn't take more than a week or two to at least get a rough draft. Part of that is kind of with the safe harbor rules, which we can get into in a slide or two. But it shouldn't be this 2 to 3 month really extensive engagement. But right now, I would say, if there's a 409A to get a valuation done in the next month, especially before year end, a lot of valuation firms are really slammed right now. And so if you have needs, I would definitely suggest to prepare in advance, just because of the high activity and how slammed a lot of the valuation providers are. Have we got any questions that have come in, Tara?
No, but I have a question, McCoy. We have a couple
Okay.
of people. We have one from Helsinki and another from Argentina.
Okay.
409As, where geographically speaking are they relevant?
So if you're doing business inside the US, or if you have US employees, it is relevant. And there are other statutes. I'm not an expert on it, but Canada has got kind of their own 409A statute. Some of the European Union countries have their own similar type statute. But IRC 409A is an IRS regulation applicable to companies that either have employees in the States or doing business in the States.
Thank you so much. And I do encourage other people to submit questions in the chat. This is going to be great. Thank you, McCoy.
Yep. Okay, we'll keep going. So I've kind of got this model here to show that this actually comes from one of our reports. This isn't a 409A report, but this is a enterprise range of value, kind of a consulting engagement. But you can see we're using a couple different methodologies. We've got a guideline public company methodology. We've got a couple of those, and we've got a couple income. They all kind of come in a little bit different. And then there's this range that kind of shows, right here we're taking the median, but there is a range, right? And kind of an acceptable where transactions would be defensible if they took place. Okay, so now we can kind of jump a little bit more into IRC 409A itself. I've got kind of a lengthy and boring definition written on the slide, but suffice it to say, what IRC 409A is, how it came to pass was in 2004, the IRS implemented it, which IRC 409A just stands for the section of the tax code that talks about non-qualified deferred compensation. And what was happening was companies were issuing stock options to employees for nothing, or they were backdating the option. So for example, let's say a company issues an option at a penny, and then several years later, the company goes public and those options get liquidated by the employees. And let's say they're exercised, they're liquidated for $100. The way that non-qualified deferred compensation is taxed is whatever the option is issued at is taxed at ordinary income when it's earned, and then whatever that spread is. So for in that example, the 1 penny, so the 1 cent to $100, that spread is taxed at capital gains rates. And so as you can imagine, the IRS kind of started seeing this, and it's big, huge companies that are going public in the early 2000s, late 90s are these people are kind of liquidating their options. The IRS is realizing they're missing out on millions of dollars because those options weren't really worth 1 penny. They were probably worth a couple dollars when they were issued. So the IRS came out with this rule saying that anytime an option is issued, it needs to be issued at its fair market value. And then that valuation needs to happen every 12 months or after a material event. So this kind of brings us to key points, and I'll hit on that 12-month material event in this slide. But some of the important things to understand about this statute are when the valuation is done by an independent third party, the company qualifies for what's called safe harbor. What that means is you can complete your 409A by yourself, right? You could run a list of comps, you could run a DCF analysis, and kind of get to probably a reasonable number. And some people do that, but what has been written into the law is if you have an independent third party that's a qualified appraiser do the valuation, you qualify for the safe harbor provision, which basically means if the IRS disagrees with the valuation, they have to prove that the valuation is grossly unreasonable. So it's a pretty big standard of proof for them to have to say that you're wrong. Whereas if you were to do it yourself, you don't have that same safe harbor, and you've actually got to kind of prove why it's reasonable. So like I said, there are people that do this themselves. Transparently, the chances of the IRS coming and questioning this are probably not extremely high, but they are higher if they don't see that it was done by a qualified valuation person. So really, any trusted advisor, attorney, anything like that is probably always going to recommend that you have a third party do the valuation just so you can qualify for those safe harbor provisions. The next thing is that the valuation becomes stale after 12 months or after a material event. So for example, let's say that we have a 409A that is done on January 1st, 2021, and I want to issue options on February 1st, 2022. If that's the case, I can't actually use that 409A from January 1, 2021 if I'm issuing the option over 12 months later, because that 409A price, that option fair market value, is stale, and that would be cause to incur penalties should the IRS come and question those options as well. So the material events that we're talking about, as well as the 12 months, those material events can be things like acquisitions, capital raises, or some things that are maybe not as well thought out, or people don't think about as much, are secondary sales of securities, issuance of convertible notes. Those types of things are also material events. So if you have those types of things in your company, I would either reach out to someone like myself, or reach out to your lawyer and see if that constitutes a material event and you need a new 409A valuation done to be able to issue options. In terms of penalties that are assessed to the employees, so let's go back to my example of the option being issued at 1 cent and then exercised years later at $100. Let's say the IRS comes in and says, okay, you did this by yourself. We don't agree with this valuation. We don't think that those are really worth a cent. What they'll do is they'll come in and basically perform their own valuation. And let's say, they're probably not going to be as incentivized to be super low on the range like you would, or like a valuation specialist would. So it may not be as aggressive. Let's say they come in and say those options were really worth $5. So what the penalty would be is you would end up paying ordinary income on that spread from 1 cent to $5. And then you would also pay a 20% penalty on that spread as well. So the capital gain from the $5 up to the 100 would still be the same tax, but it's really kind of that spread of where the IRS thinks it's reasonable, where you're paying both ordinary income and that 20% penalty, which may not seem like a ton, but when we're talking about exercises of millions of options and millions of dollars, when your companies all go public and they're worth tons in the future, those can be pretty severe penalties. And so that just hopefully kind of gives you an idea of what's at stake by not doing this type of valuation. And part of that is those penalties are applied to the employees themselves. And so 409A really is protecting your employees even more than it is protecting the employer. The next point is, in most cases, profits, interest in an LLC also qualify as non-qualified deferred compensation and are subject to the same valuation guidance. Basically here, this is a common question of, a lot of times people, their lawyer or their accountant will tell them, hey, you need to go get a 409A, but they're an LLC, and they'll say, hey, I need 409A. It's really, the guidance is pretty similar in most cases. The difference is you're not issuing options, you're issuing profits, interests, and we'll still value those in a very similar way. The process is just a little bit different and actually a little bit more extensive. So I would expect, just be aware that if you're an LLC, those numbers I gave you on pricing may just be a little bit more expensive, maybe 10 to 20% more expensive to be able to do an LLC as opposed to a C Corp. And then although the requirements for GAAP, so without getting too far into the weeds here, we get that price, right? The goal of the 409A is to say the option is worth X amount. Typically, that same amount is the same amount we'll use as we expense the options over time, which is a financial reporting exercise. Generally, the requirements for valuation for both that financial reporting exercise to expense the options on the P&L are going to be the same as this 409A tax exercise. And so the thing to know there is as you're engaging someone for 409A, I would just make sure that the number and the methodology used can serve for both purposes. They can serve for both ASC 718 and IRC 409A. And again, if you've got more questions on that, feel free to ask me after, or ask in the chat. And then, as I'm sure you can imagine, the incentive on 409A is to be on the low end of the range, right? We want to be as aggressive as we can while still being defensible, because we want to avoid those ordinary income taxes. But again, we're not you want to make sure that you have a provider that's being aggressive, but it's still going to be defensible, because there's no point in getting this type of thing done and paying all this money to have it done if it's not defensible. So that's the goal for us at Scalar on these types of engagements, is to be as aggressive as you can while still having it be defensible. Any questions on those key points that have come in, Tara?
No, there's not at this point, but this is
perfect.
Great.
Perfect. So again, I'm not going to do a super deep dive, but I do want to kind of talk about how this valuation is performed, because I think it's important as you're talking through it and as you're trying to figure out how aggressive can we be, and understanding the valuation, to kind of understand what's going on. So there's 3 valuation approaches that any sound valuator is going to use. And these are kind of the theories that are taught in school. If you've got a finance degree, you probably learn these types of things. And we can kind of go over all 3 of them briefly. So the first is a market approach. So the market approach is similar to what I was talking about with that real estate example I gave several slides ago. It's similar to looking at like a real estate comparable or a car comparable, and finding an implied multiple. So in your business, it'd be something like revenue, EBITDA, ARR, any type of implied multiple that's used in the industry, and then applying that multiple to the company. So there's a couple different ways that we do this market approach. The first one would be through public company comparables. So we can look at information that's public. There are some limitations to doing that, including, if there's not a lot of trading history, or if there's industries that are kind of unique, like cannabis, or other types of industries that aren't being traded a ton, that public company method may not be the best method. The next method would be a precedent transaction method. So we'll look at companies, public or private companies, that we have data on, that are in a similar location, similar size and stage, and we will kind of baseline off of those precedent transactions. And then the third one would be if there's been a recent security transaction. So if your company has recently just gone through a Series A financing, we can kind of back solve off of that financing to give a pretty good indication of value of what the company is worth based on that market approach. The next approach is the income approach. So this is one where I'm sure anybody that's seen any type of discounted cash flow analysis, this is what we use at Scalar. We kind of stick to the DCF model just because it seems to be the most widely accepted and the most efficient way of being able to do this. Essentially, what we're doing here is it's just a time value of money exercise. So we've got several inputs that are put into the model, and then we will look at what cash the business is going to bring in the future, and then discount that back to the present value. Basically, the theory behind that is the company is worth what cash it's going to generate in the future. And so there's a couple different ways to kind of run that income approach as well. But ultimately, the goal is through these different approaches to be able to use the approaches and weight the approaches in a way that makes the most sense with the company, to anchor that enterprise value to these approaches that makes the most sense. So the last approach here is the cost approach. This is, you've got $10 million in the bank, so your company's worth 10 million. This is by far the least widely used approach. Typically, if you're going to go do a 409A, you're going to have some type of combination of a market approach and an income approach, and that's going to get to your enterprise valuation. So once we get, go ahead, Tara.
We have a quick question that I wanted to ask, and it's going back to incentivizing of where you want to be on the range. Can you please revisit why you want to be on the lower end of the range again?
Yes, that is a very good question. That's probably the most common question when we have, if I have a scoping call with somebody that's doing a 409A engagement of, wait a minute, I want my company to be worth a lot. Why do we want it to be worth a little bit? The incentive for 409A is to be on the low end of the range, because let's say that the option is issued at $1, right? When that option is vested or when it's earned, it's going to become taxable as ordinary income to the employee. And so that dollar is ordinary income. And let's say in 10 years, that option is worth $10 and the employee can sell the option buy at the option price, the strike price, sell at the current market value. They had ordinary income up to $1 and then they have capital gains up to $10, right? So if the value of that option was $5, they'd be paying ordinary income up to $5. And so it's really a tax exercise of the lower the value of the option, the lower taxes the employees are going to have to pay. I hope that answers the question.
I'll let you know if more feedback comes in, but that's great. I think
Okay.
lower taxing, big deal.
And a follow-up to that is another common question is, is this something that I need to show my investors? Like, if I've got investors that are expecting X return, do I need to show them my 409A? And kind of two parts to that answer is first, any savvy investor should kind of understand the purpose of 409A. They should kind of know, like, this is not what we're selling the company for. So it's not necessarily an indication of what we could sell for. And so I think understanding that as well, and also understanding that this isn't necessarily something as you're going to raise capital, there may be an investor that says, hey, let me look at your 409A. It's not necessarily something you need to share in that setting either. Just knowing the purpose of it, right? Okay, so now we'll kind of get down to how do we actually get to a price per share. Ultimately on the report, what I want to see is your stock, the security at a non-marketable minority basis is worth X amount. That's the whole purpose of this engagement, is just to see what is the strike price of my option. And so this is how we get there. And this is kind of applying some more kind of discounting things to drive the value a little bit lower that are market standards and acceptable in the market to be able to do that. So like we were talking about, we get to the enterprise value of the company through those methodologies we just talked about. And once we get to that number, there's two main things we have to do. The first is we've got to allocate the equity. So what this means is if you've got several different preferred, depending on what your cap table looks like, if you have preferred shares, you've got shares with rights above and beyond that of the common shares, they're not worth the same as the common shares, right? If you have liquidation preferences, you've got some type of conversion rights, or you've got dividends or right of first refusal, those rights are worth more than what a common shareholder has. And so the first thing we have to do is we have to allocate, okay, if we have preferred shares here, what is the value of the preferred share versus what is the value of the common share? And we use an option pricing model to be able to do that. Essentially, we're just trying to give a dollar value to those preferred rights of the preferred shareholders. And then we'll take the common shares, and from that number we get from the allocation, we will apply certain discounts. So there's two main discounts that will apply in 409A. The first is a discount for lack of marketability, and the second is a discount for lack of control. So a discount for lack of marketability is just the fact that this is a private share. It's not traded on a public exchange. And so for me to be able to sell this, it's going to cause, it's going to take a lot of my time, and it could cost me money to sell it. And so because of those things, we can actually take a discount for that lack of marketability, since there's not an open market for the option itself. And then the second one is a discount for lack of control. So because we're reporting this on a minority basis, there's certain discounts we can take, saying, hey, if I really wanted to make some type of decision here with my option, I really don't have control of the company. And so there's certain discounts we can take there as well. So after we apply that allocation and those discounts, we'll arrive at a value on a non-marketable minority basis. basically just saying we've applied some type of discount for lack of marketability, we've applied some type of discount for lack of control, and this is the number that you can exit or you can issue the options at, which will become the strike price of the option. Common questions with the discounts, as I'm sure some may have, is like, well, what can I expect for a discount for lack of marketability, or what can I expect for a discount for lack of control? The discount for lack of marketability really can come in anywhere between about 20 and 50%. And that is based off of kind of industry data and a lot of market research that has gone into that's pretty widely accepted, but a lot of it's just kind of based off of size and stage of the company. And then same with the discount for lack of control, similar type of process where we've got a lot of research and studies that are pretty well accepted in the industry, that'll come in anywhere on the discount for lack of control, come in anywhere between about 10 and 20%, I would say. And those two don't necessarily stack on top of each other. They kind of work together. And so, you know, if kind of both of them apply, again, I think you can probably expect a discount anywhere between 20 and 50%. From whatever the you know, equity allocation down to, you know, the difference between the equity allocation and the final strike price. So hopefully that gives you kind of an idea. I think those things are important to understand, just to kind of get like, okay, how is this just some guy waving a wand in a back room that's figuring out my strike price, or how are we even getting there? That way you can kind of understand, you know, hey, talk to the valuation provider. Hey, what is our discount for lack of marketability and how did you get there? I think those are really, you know, savvy questions to be able to ask somebody as you're going through one of these exercises.
Okay, we have another question coming in.
Perfect.
And by the way, this is fantastic. Thank you guys for submitting them through the chat. The question is, if the 409A governs stock option price, does it not govern effectively the common share price in general?
Yeah, you know, we do a lot of similar type of engagements where people just want to know what the share price is, whether it be for transferring shares. You know, sometimes that's like a gift and estate type deal. Sometimes it's something else, whether they're just kind of transferring shares to somebody in the company. So the valuation engagement we would do would be pretty similar to a 409A type engagement, but 409A applies specifically to the non-qualified deferred compensation. And so while the engagement looks very, very similar, it's not necessarily under that same statute.
Okay, so how does the valuation affect the price of the common shares that they received from the 409A and the deal they got from certain investors? Like, how does it all?
So say that question one more time.
How does the valuation affect the price of the common shares? And it's written, how does the valuation affect the price of the common shares I got from the valuation and the deal I got from some investors?
Okay. So again, it's kind of, sometimes people will use 409A for different purposes. Mm-hmm. But the purpose of this report is strictly to know the fair market value that you can issue options at. So if an investor wants to say, hey, what's the price of this common share? Let me look at your 409A report. Again, that's not necessarily the purpose of the engagement. If we were trying to say, hey, let's figure out what the price of these common shares are because we're getting ready to sell, that would be a slightly different engagement than the 409A itself. So my answer to that would be, just be savvy of what the purpose of this report is and use it accordingly.
Okay, so there's effectively two parallel common stock prices.
Yes and no, right? We're still gonna, like, if we're transferring, depending on what the purpose is, we're still probably going to apply some type of discount for a lack of marketability. We may apply some type of discount for a lack of control. But if we're selling our shares, like that discount, it's not as less marketable because we're trying to sell them. And so it just wouldn't make as much sense to apply that discount. So that's why I mean, like the purposes are a little bit different. It doesn't necessarily mean the cost or the value of the shares is different. It just means we're looking at it in a little bit different way because of the fact pattern.
I think that's really good. Thank you. And I'd love to encourage other people to submit other questions. Otherwise, that were all the questions. So please continue, McCoy.
Okay. And then the list of documents needed, I'll have Chris kind of jump in and tell us the things that are important here. But typically, we're going to ask for a business plan, any type of slide deck, if you've got something ready for an investor, just to give us an idea of the company. We'll look at a list of competitors and comparable firms. We can pull that data, but if you have something prepared, that helps. The most important things are the things here bolded. Income statement and balance sheet for the last 3 fiscal years ended. Obviously, if your company hasn't been around for 3 years, then we're not going to ask for 3 years, just whatever you have. But these are kind of ideal documents that we would ask for. The next one is the income statement and balance sheet for the trailing 12 months. And then financial projections are very important. That's a lot of what we're going to run any type of income approach analysis off of, would be those projections. And then obviously a cap table showing the strike prices of any outstanding options. So I've asked Chris if he wouldn't mind just kind of going through some of the pitfalls he sees as people are, whether they're preparing for evaluation, whether they're preparing for an audit, things that he kind of sees pitfalls in terms of preparing financial statements.
Thanks, McCoy. I really appreciate your slide. On one of them, in the same sentence, you had a codification reference for GAAP accrual accounting and the Internal Revenue Code section reference. I'm amazed. So you get little bonus points for that. Let me go back and answer that question too, as far as why you want a low, a 409A valuation is, at the end of the day, is really for tax purposes for your employees. You're trying to protect your employees and be able to give them capital gains treatment on the appreciation in value in their stock options. And let me give you a quick example. So 2 years ago, we had a client. They'd been in business for 4 years. They were came in and were acquired by a strategic national bank. The price of the acquisition was around $200 million. For the 4 founders, well, the 2 founders and then the 2 other key executives that had been gifted options in year 1 and 2 of that 4-year company, where the valuation was extremely low, right? And then all of a sudden they're selling off at $200 million. The savings and taxes were about $30 million worth because they'd had 409A evaluations in year 1, 2, and 3 before they sold in year 4. And so remember, at the end of the day, that 409A valuation is really to protect your employees and give them a lower capital gains tax treatment for their options, okay? And that's why you want low, so that most of that appreciation in value is going to be taxed at a much lower capital gains rate, okay? So it can have a huge impact. Those 2 key employees that saved millions of dollars in taxes were very grateful that the company had done a 409A valuation for them. So McCoy put the list together here. It's kind of, think of it as the standard. This is kind of the standard list you'd get if you were going in for a bank loan. This is also the stuff that investors are going to take a look at. Make sure that when you have your income statement and balance sheet, when you go back historically, make sure they're on the same basis of accounting. A lot of startups start out with cash basis accounting, and then in year 2, 3, 4, they move into a true accrual accounting. Just make sure that when you're providing financial statements for year over year over year, is that you keep them on the same basis of accounting. So if it's cash basis, cash basis. If it's accrual, make sure it's all accrual, okay? Don't have anything misleading. The trailing 12 months is to see what's really happening with the company right now, right? Because that trailing 12 months of income statements and balance sheet should be the basis for your financial projections. And I always love it when we talk with startups and it's like, hey, let's take a look at your financial projection and what does it look like? Every one of them is a hockey stick, right? It's just going way out of line. And then it's like, what's the backup for your projections? Well, that's what we think we can get to. I would tell you that to go through evaluation and have something that's going to be able to stand up to scrutiny, spend a little bit of time with your projections, make sure you have clear assumptions set up, make sure that you have clear, cost of goods sold if you're selling goods, you've got development costs, you've got everything in there that you should, and track it. The more sophisticated the model and the more realistic the model is, the better your valuation is going to be. Okay. And then my favorite, that cap table, right? That's something that you need to keep religiously. That's where all of the issuances are. And so we had one a couple of years ago. The president, he was famous for gifting stock at year end to all of his favorite employees, right? And for the first 3 or 4 years when they weren't making any money, didn't really matter. But then when they were coming to be sold, right, all of those promises and emails came out and they weren't in the cap table. And it was a very messy process documenting all the promises that had been made in the prior years that weren't documented. Okay, so keep a clean cap table. If you've gone through a couple rounds, make sure that you're using something like Carta or another cap table management tool. Those are the best and easiest. And that's what you're going to go back to if you've got a big transaction that comes up. Okay. The rest of the information, it's pretty standard. As a company owner, founder, you should have this in your, you should have that really at your beck and call. It should be easy for you to provide. I always wonder when we have people come in and do evaluation and you say, hey, we need the last 12 months of financials. And they're like, well, we haven't closed out any months this year. Well, now you're making the valuation guys, you're making the job harder for them. And so good, clean monthly cutoffs and financials for interim periods, that's going to help you get the better valuations. And so all the stuff that's here on the list, it's just part of having a well-run business. It's part of your monthly financial package. And so let's make McCoy's job a lot easier and make sure you get him good, clean financials. And so anyway, McCoy, if you want to take it to the end, and then Tara, I think we're going to open it up for questions.
Exactly. Well, we did get a question that came in real quick about a copy of the presentation recording. It is being recorded. The presentation is also available. We'll email it to you by the end of the day. So don't worry about that. Please.
So I want to just kind of reemphasize what Chris said. Chris, thanks for jumping in. I think the reason why your valuation has a potential to be better if these things are cleaned up is, here's one example. Just like Chris said, we see forecasts all the time that are big hockey stick curves, which is not necessarily a bad thing. I mean, the one thing that we know about forecasts is they're wrong 100% of the time. No matter how good of a forecaster you are, they're always going to be wrong, right? And so as a valuation firm, there's certain things we have to do to mitigate against that risk. And so, for example, let's say we've got a company that has done 0 in revenue for 3 years, and they've got a projection the next year to do 25 million. Well, maybe they say, hey, we've got a government contract, we've got an LOI for $18 million for this government contract. That's part of why we have this forecast. And they've got it all detailed out, and we can kind of see, and it makes sense, and it's defensible. In those cases, we can mitigate risk against those things that we can see. If there wasn't any type of thing to back that up, or the forecast just was kind of throwing darts out on a dartboard, we've got to mitigate that risk in another way, which could be to apply a lot steeper discount rate, which ultimately is going to affect the valuation. And so just to kind of hit home with what Chris said, the accuracy of these statements do actually come into play, especially on a non-409A engagement. Like if we're trying to go raise money and we have forecasts that aren't really supportable, as a valuation firm, we have to mitigate against that risk, which could hurt the valuation. So that's kind of all I've got. Hopefully, if there's any other questions, feel free to reach out. I've got my info here. I know Chris has got his that will be sent out. Even if it's just kind of a, hey, here's a general question about valuation, feel free to reach out. It doesn't necessarily have to be we're trying to engage Scalar right away.
We had one more question come in real quick. How much of founder shares should be subject to vesting when issuing the stocks for the first time? Do investors require the shares to be vested if there is a solo founder? If I can just take a swipe at this at the very first, being Boom Startup Accelerator and knowing what we know about the pre-seed round, founders' shares, the more that is vested, the less incentive it is for the investors to participate, because they want to see the founders stick with the company as it grows, and that they're betting on the jockey, not the horse. And so they're betting on the relationship with the founders. And so if the founders just basically pocket the ownership of the company, it's not very appealing at all to investors. So putting founders on vesting plans and schedules is in fact attractive. But I would love to hear McCoy and Chris answer this question too.
I don't have much to add, Tara. I think you answered it great. I don't know if Chris has got any other insight.
Yeah, just a huge reaffirmation of that, Tara. I mean, with investors, they're investing in the management of the company, right? It may have a great idea, but their big payoff is going to be when the owners have a big payoff. And to have them as part of the cap table and on there, and they've got skin in the game, that's going to be much more attractive for them as an investing. And so you hit it right on the head, Tara.
There was also a question about a solo founder, and I think the same principle applies.
Yeah, I would say so.
Yeah, think of it as, again, those investors are they're going to be investing in you as that solo founder, right? And their big payoff is going to be when you're with your big payoff. And so make sure you've got the skin in the game and you're listed there with the founder's share.
Yep, I agree. The bigger the pool, the more incentive, and the more important the 409 is. The other aspect, I would love to ask you both, how often have you seen the founder's ownership having to reset on investment rounds? I know it doesn't usually happen on pre-seed. It's a little bit later on, like seed or series, but how often do you guys see resets of founder stock?
Frankly, we don't necessarily deal as much with that, just because once we kind of perform the valuation, we're not as involved in the capital raising itself from kind of a day-to-day perspective. So I'd be interested to know if Chris has any thoughts on that.
It's pretty much, think of it, every transaction round after the seed round, you're going to see that. And it's going to be depending on where's the company tracking to, right? Are they starting to get lots of revenue, right? And so but think of it, almost every round you're going to see that reshuffling and redoing of the valuations and the ownership.
Yeah. So resets and dilution are definitely a big part of the game when it comes to capital raising. Great questions, Luca. Thank you so much. Other questions, please feel free to enter them into the chat. But I just can't thank you enough, McCoy and Chris, for bringing this very important topic to the table at Boom Startup. It's a really important aspect on structuring your business correctly from a financial standpoint, so you don't penalize all the people who are putting in the blood, sweat, and tears and years, especially those that are the most high risk and reward, with bad stock option plans and missing out that opportunity of avoiding high taxes. So this is so important. This is fabulous advice. Thank you so much.
Yeah. Think of it as if you've got a good company and you're taking care of your employees with all of those benefits and perks and free food and drinks, and then you forget about your 409A valuation and you cost your employees hundreds of thousands of dollars in taxes or millions of dollars in taxes, you really weren't taking care of your employees like you should have.
Mhm.
And McCoy, tell us a little bit. I know you guys are international too. We had some people here from Finland and I believe Argentina. So I know you guys got some overseas offices. Where are you guys at?
So I mean, most of the valuation work we do has companies with some tie to the U.S., similar to how I was saying with 409A, they're U.S. employees. But we actually have an office with about 15 Scalar employees down in Cordoba or Argentina. Just a group of really outstanding valuation professionals, actually, that we found a little niche to have people help us out down there. And they'll do a lot of kind of the market research, kind of a lot of the more support type stuff, not necessarily going out and valuing a bunch of companies in Argentina per se, but doing a lot of the really good work that's done in our office.
Excellent. Well, thank you so much. Well, with no further ado, I'll let y'all go. Thank you so much for joining this Boom Startup Accelerator OpenUp program, and we hope to see you in the future ones. Everyone, take care.
Thank you, Tara. Have a great one.
Ciao.
Thanks, everybody.